Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show. On this weekend show, we're going to be focusing a lot on the metals sector, especially the precious metals, making sense of the correction and now pretty strong rebound in the metals prices and a number of the stocks. This definitely isn't an environment where all the stocks are rebounding to the same degree. And you can make the argument in some cases that the metals are rebounding stronger than some of the stocks. So gives us a lot to talk about on this weekend show, and also a topic that we have been covering throughout the week through daily editorials, as well as discussing what's going on in some of the other markets, which seems like a bit more of a rebound now that the U.S. government is reopening. We are kicking off this weekend show with our good friend Matt Geiger. Matt is the managing partner at MJG Capital. We'll be talking more so on the equity front for precious metals, and also really asking Matt if he's been making any changes to his funds portfolio. Matt, let's start off with the whole concept of this precious metals pullback. Now a bit of a rebound as we're recording this halfway through the week. We do have silver back above $50 an ounce. Gold has also rebounded, trading right around $4,200 an ounce. A couple strong days to start the week. A lot of people were asking the question, is this more than just a correction? Is the precious metals bull market over? This bounce probably has more people leaning on the side that says this could be just another continuation leg in a normal correction. But what does Matt Geiger have to say about it?
Oh boy, well, you're really putting me on the spot right to start the interview here. I mean, I will say first off, I think anybody telling you with full certainty that they know where the gold price is going to go in the short term here, should be viewed with extreme skepticism. With that said, if you're asking me to gaze into my crystal ball, my base case here, and again, I'm saying this with a low degree of confidence, is that we are well due for a correction, probably of the magnitude of 6 months or so. I should emphasize, I am not of the view at all that this bull run in precious metals is over by any means. However, I think the confluence of a few factors that we've seen in recent weeks and in the past couple months suggests that the fun is probably over for the time being. So the first of these factors that I'll point to is really just the attention that gold and precious metals more generally started receiving going back to August, say pre-Beaver Creek, and really increasing through October. And this is by Western institutional investors, Western retail investors, and very notably the mainstream financial press. And, anecdotally, especially late September and into October, reminded me a lot of the, Q3 2020 period, where personally I had childhood friends, university classmates, some generalist fund managers even, reach out to share their excitement about precious metals. And I even had a childhood friend, talking about how well his silver call options were doing that he'd purchased in September. And, while I'm happy for him and I'm happy for the enthusiasm, emanating from generalist investors, this type of excitement from non-mining types always makes me nervous. A second point from a technical perspective, one can also look at the quarterly RSI on gold, which at October month end, roughly matched the RSIs that we saw going all the way back to 1973 and 2008, which in those periods turned out to be short-term peaks in what proved to be longer-lasting precious metal bull markets. And then a third indicator, this is just a rough one, but was seeing silver reach, $50 per ounce in mid-October for the first time going all the way back to 2011. And, silver bulls will tell you how significant the $50 level is, both from a technical and particularly from a psychological perspective. And this goes all the way back to the Hunt Brothers squeeze in 1980. And while I do ultimately expect silver to climb probably well above the $50 level before this precious metals bull market has formally concluded, it just didn't seem to me that we would easily be able to slice through that level by any means. So those are the factors giving me caution here in the short term. With that said, especially with the price action over the past few days, I wouldn't be surprised at all to actually see the gold price sweep to all-time highs here in the coming few weeks. Maybe top out at around 4,500, just as a rough figure, and then formally enter this corrective phase that I was speaking about, or at least a consolidation phase, if you want to call it that, and maybe retreat back to the $4,000 level, or into the 3,000s for a good 4, 5, 6 month period, just to allow technicals and sentiment to reset before we're ready for another proper leg higher. So that's my best read on where we stand today.
Well, Matt, just following up on that idea, as we talk today, with gold above 4,200, with silver pretty close to an all-time high, just as we're speaking here. It's at 53.58 on the futures market, so 50 cents more, and we're at an all-time high in silver on a nominal terms. I know, not inflation adjusted. But when I think about where we're at in the quarter, we're halfway through the quarter. We're mid-November here. The fourth quarter has had the highest prices we've ever seen in gold or silver on an average basis for the producers. Now, I know that we're going to normally talk about the juniors, but the producers are what's in the GDX and GDXJ, or the SIL and the SILJ. The producers are what the largest propensity of funds from generalists are garnering, and that's how a lot of people track the sentiment in the sector. Do you think that at this point that the gold equities or the silver equities are really factoring in these higher prices in Q4? Because it's a big jump from where Q3 was, which was a big jump from Q2, and I still don't see it being factored into the valuations.
I mean, I think you're right about that. Obviously, the precious metal producers have finally this year exhibited really excellent leverage to the gold price. Roughly 2x leverage to the 55% move that we've seen in gold year to date. At the GDX and the GDXJ up 120, up 130% in that general ballpark. So we've seen leverage, which is good, but they're coming off of such oversold levels that I think there is plenty of catch up to be done. With that said, that catch up does not have to occur in the next few months. This could be a multi-year process of the market finally acknowledging that these higher precious metal prices are here to stay, and that reflecting in the valuations of the bigger guys. So if we do see this gold correction, in the coming couple quarters, coming quarter or two, even though I do not think that current metal prices are factored into these companies' valuations, it wouldn't surprise me to see a general pullback amongst the larger producers as well. There of course will be exceptions, those companies with specific catalysts that can drive a re-rating higher. I think M&A will only continue. Like, since we've seen this, concern about a gold correction kind of going back to October 20th, we've had a handful of pretty big deals that have been announced in the subsequent period. I'm thinking about IAMGOLD tying up Northern Superior, the Fresnillo takeover of Probe Gold, and then of course the core New Gold merger as well. So I still think the producers will track precious metals in the very short term, but if you're thinking out medium or long term, we could just have gold stay flat at 4,000 for the next few years, and I think the producers could more than double from current levels over that period.
Matt, how do you go about analyzing some of the earnings that we're getting out of the majors? Because quite frankly, it's a consistent record revenue, record margins, record earnings, record cash flow, really across the board. But it was interesting to see as Q3 earnings started to come out, no matter what the headlines were, if gold was in a corrective phase that day, the stocks were getting hit. Now, understandably so, these stocks are much higher than where they were last quarter when they were reporting. So again, when we see these earnings reports, how would traders even play them when it does still seem like the big stocks, all the stocks, are somewhat susceptible to what the metals price is doing in that shorter term period?
Yeah, it's a good question. I mean, to be frank, I'm not following the ins and outs of major earning releases as much as some of your other guests. As you know, the MJG fund is thoroughly focused on the junior end of the spectrum. Every single one of our holdings, except for Altius Minerals, has a sub $1 billion market cap. With that said, in a general sense, I think all investors should be honed into the all-in sustaining costs that are being announced by the various producers. It's really the one thing that those companies have some control over to some degree. And so, the less cost creep we see really across the board, the better. And then from my self-interested perspective, I'm looking for hints that the bigger boys are shifting some of this, large amounts of free cash flow that's being generated, towards exploration. And that could either be, directly funded exploration carried out by the companies themselves, or, partnerships with smaller juniors. And I think we talked previously about Centerra as an example of one group that has really been at the forefront of, using their excess cash to get aggressive, back smart groups doing early stage exploration, and then let them do that work for Centerra. So I'm still looking for a broad-based shift towards exploration. I think it's coming. I don't think we've quite seen it yet. I think, debt pay downs, dividends, share buybacks for sure are currently being prioritized, but I think we slowly see that shift in the quarters and years ahead.
Well, Matt, just within your own portfolio, I know you focus more on the junior side of it than the producers, like you mentioned. So when you look at the explorers, when you look at the developers, I guess same kind of idea as the last question. Do you think the developers are really factoring in these higher metals prices or even the M&A deals that you just mentioned? Because, we looked at the probe gold takeover. If in US dollars, it's I think $56, $58 an ounce in the ground. The margins that these producers are making are 1,500 to 2,000. Why aren't development projects that are coming up with the next batch of mines getting above 100 or even 200 or $300 an ounce in the ground for these projects? Why are the M&A deals still so small? Why are the developers not factoring in these higher metals prices?
Yeah, I mean, if you look at the probe gold deal in particular, that was very cheap on a per ounce basis. I think we're talking, $55, $60 an ounce for the price that Fresnillo has offered. I will throw out the possibility of an interloper coming in and launching a competing bid. I think that's less likely than more likely, but if you look at the probe share price, it's suggesting that at least some folks out there think that is a possibility in the coming weeks. Look, more generally, I mean, it's always a case-by-case basis. Certain development stage projects deserve very high premiums on a cost per ounce basis, just due to all the factors that one should look at, fundamentally. The grade, the depth, the metallurgy, the proximity to infrastructure, the size of the project. So there's nothing wrong with, disparities between specific development stage plays. But I think your broader point stands. We've definitely seen some trickle down, to the more junior end of the market. I'm not gonna say that we haven't, especially going back to August. It's been a good period for the juniors, and they've played some catch up to the big boys. But I don't think by any means anybody could say that especially the development stage names that you mentioned have gone too far too quickly. And I think at the current multiples that many of them are trading, they remain attractive M&A targets going forward.
So, Matt, since we're talking so much about valuations, I was talking to somebody earlier this week who runs his own book, and he made the comment that valuations are inherently arbitrary. And he says, look, the market is valuing assets at what it values it at. And when we look at such a wide range, whether we're talking majors, mid-tiers, juniors, and we're saying that most of the sector is undervalued, how do you go about analyzing what should get re-rated when you're kind of making the argument that the whole sector needs to get re-rated? This ties, I guess, more into how you're managing your portfolio, because look, if we're sitting here saying majors are undervalued, mid-tiers are undervalued, development plays are undervalued, what do you buy in this environment?
Yeah, I mean, it's a difficult game. I'm not sure if this friend of yours was suggesting giving up on trying to value companies, because I would strongly suggest that that's not the way to go. I think each individual investor needs to have their own framework, but I think it's an extremely important process for any investor, and I'm speaking from a bottom-up fundamental perspective, to do your very best for each and every one of your holdings to come up with either an expected or a fair value for each of your investments, depending on the stage of the company. And of course, there's going to be wide variations, even for specific, for the same company amongst different investors. Like a huge variable is, what gold price are you assuming? Are you taking the more conservative route like the majors are and plugging in 26, 27, $2,800 gold when you're running your models or looking at the sensitivity analysis in feasibility and pre-fees and PEAs? Are you plugging in $3,500 gold, which is a pretty decent delta from where we're trading currently? Or are you getting more aggressive and plugging in the spot prices? And I think that comes down to each investor's individual preferences and outlook. But ultimately, even just from a relative perspective, I think it's important to have a framework for how you're thinking about valuations. And yes, it's possible that a rising tide will lift all boats. I mean, I think that's likely true if you're thinking, going out 2 to 3 years. But that doesn't mean that the gains will be evenly distributed. And I think if you're in this for the thrill of the hunt, you should be looking at the names that are going to provide that alpha or that outsized performance relative to the rest of the pack.
Well, Matt, within the MJG Capital Fund, are there any actions you've been taking in light of some of the price swings we've seen in the precious metals or in the base metals or critical minerals? Anything changing in your portfolio?
Yeah, I mean, in short, yes. Within the past month or two, we'll say, we have liquidated two precious metal focused investments entirely and have also taken profits on a couple others as well, especially in that run up in late September and into late October, which I think was a great period for at least some profit taking. Our weighted exposure to precious metals as it stands, and this includes gold, silver, and I'm lumping in PGMs as well. It sits at roughly 30% of the overall portfolio as of the end of October, which, believe it or not, is actually our lowest exposure to precious metals going all the way back to 2018. This is not to say that we are staying away from new precious metal investments. I mean, if anything, I think relative to other investors in the space, we're quite underweight precious metals at the moment. So we have the opportunity to add a couple names where most investors are very pregnant on PGs at the moment. And in fact, we just wrote a check to Ongwei Minerals. This is Hayadon's next deal, Namibia gold-focused explorer. I think we talked about the Headwater Gold financing that we participated in a couple months back. So we're still actively deploying to precious metal focused names, no question. However, I don't think it's a bad time, for investors to look through their gold and silver juniors, particularly if they're looking at their mining portfolio and 60 to 70% of the weighted portfolio is precious metal focused, and go through name by name and really think, first, is my investment thesis still firmly intact, first and foremost? And second, do I still think there's a significant disconnect between the current price and what I deem to be either fair or expected value? And I would say if the answer is not a resounding yes to both of those questions, it could be worth reevaluating whether to hold on to that position, because there are plenty of fish in the sea. You guys well know there are 3,000 of these juniors out there at this point between North America, Australia, and the rest of the world. Roughly half of them are precious metal focused in one form or another. So there's no shortage of opportunities. And then just going back to the MJG portfolio, we're still heavily overweight copper, as we discussed in our last conversation. And this is through investments in copper-focused developers, explorers, and heavy and copper-focused prospect generators as well. So our weighting towards copper is a little bit higher even than since we last spoke, at around 46% of the overall portfolio. And we also now have a double-digit cash position within the fund, which is really a big shift from where we were, between really early 2024 up until April, May of this year, when we were fully deployed over that close to 18-month period. But I've made some effort, and it's been difficult, especially when you have the portfolio as a whole rising month after month after month. But I've made a concerted effort to bump our cash position up into the low teens where it currently sits.
Matt, thanks for sharing those numbers. Those really struck me here. So just in summary, lowest exposure ever to precious metals, overweight copper, and you have built up cash. This is something we were talking about months ago. Also with you is that not a bad time to at least lock in some of your gains in the precious metals. But then look, a lot of the shareholders or people especially the precious metals bugs, are always touting about higher gold and silver prices. Silver could go to $100. Just think about how that changes their overall assessment of their silver stocks, even their gold stocks. If gold keeps running higher, what are you looking to do with your cash then? Are you going more into copper? Are you finding other metals that haven't gotten the exposure that the precious metals have? Because I think those numbers you shared with us are a very telling story.
Yeah, I mean, I would say broad strokes for the cash position, and this can be difficult to do, especially when there are so many opportunities, so many financings. Companies have been cashed up now for a number of months, and we're seeing a lot of news flow. We're seeing exciting drill results. Like the space is really picking up in a positive way. But my goal here is to remain disciplined and largely hold that cash position, less concerned about a broader correction, specifically for commodities, but more concerned about the general markets. And when we have that next, April 2025 like liquidity event, or the interest rate tantrum, going back to 2022. That will happen. I don't know if it's next month. I don't know if it's a year from now. But I think it's good discipline to hold on to a decent cash position, and so you have the conviction and courage to deploy it when that occurs. That of course won't stop us from making new investments in the intervening period. It will probably just be more of a one in, one out situation in terms of when we bring new holdings within the portfolio. But in terms of where else within the commodity space, I mean, I believe we touched on this a little bit in our last conversation, but I'd really harken back again to Q3 2020. And that's when precious metals and precious metal equities peaked after their extremely powerful moves, out of the COVID lows from spring of 2020. And this temporary peak in precious metal prices did not spell doom for the rest of the metals complex and commodities more generally. In fact, it spurred a powerful, what turned out to be an over 18-month move, well into the spring of 2022 for basically all non-precious metal commodities. And we're talking energy, we're talking base metals, we're talking battery metals, ag minerals, really, you name it. And we're at a juncture now where basically all other metals are cheaper relative to gold than they were even in Q3 of 2020 when gold was at its short-term peak at that time. And, copper is very much included. So that speaks to our confidence around copper at the moment. And so my strong suspicion, and I say this with a higher level of confidence than my crystal ball gazing in terms of the gold price moves in the short term here. But my strong suspicion is that we'll see some serious catch-up played by the rest of the metals complex. And this is really irrespective of whether precious metals are down, flat, or up in the coming months. And so I think if this does occur, the MJG portfolio is well positioned for that, with a good 60% of our portfolio exposed to non-precious metal mining equities as it stands.
Well, Matt, can we dive under the hood a little bit further into which ones are animating you? I know that for you, it's always a company by company basis. It's not the metal first, but there's things like the critical minerals, not just copper, which would be one, but I guess silver is now a critical mineral according to the U.S. as of last week. But I'm talking about things like the antimony, the tungsten, the rare earths. There's still lithium that could be coming off the basement. There's still uranium stocks. Any other metals that you're animated by?
Yeah, I guess I like the metals that haven't seen speculative furor in recent months. So I think that would exclude rare earths for the time being. I think that would exclude tungsten. I think that would exclude antimony. But I think, the rest of the non-precious metal, space is fair game. But, as it comes to copper, like I'm clearly very comfortable with that metal. And, there's a number of reasons for that. The first is the incentive price in order to bring the next generation of large scale copper development projects online is probably in the low to mid $6 range at this point. It just keeps rising quarter on quarter. And so we'd have to have a good 25%, potentially up to 30% move from the current spot copper price before, kind of the median development stage copper project that has enough scale to matter really starts to make sense on paper. And, Brien Lundin, the CEO of Altius Minerals, a longtime holding of ours, someone I very much respect, harps on this. But his point is that if you look back to previous metal cycles, you will very often see the actual metal price move, 2x or more above the incentive price, just due to the long lag times between when you press go on a project and before that new supply actually comes online. And that's even more true for copper because you're looking at, 4 to 5 years from a construction decision before these large scale, porphyry projects, actually have a chance of reaching nameplate production. And that's if construction is executed well. So I really like that perspective. And, another point I believe we've touched on previously, but if you're a junior, whether at the exploration stage or into the development stage, with a good copper project with enough scale to matter, there is simply no shortage of buyers out there. This of course includes the world's largest diversified miners, which have been vocal for years now that they're zeroing in on copper. It includes the largest Western gold producers, Newmont, Barrick, though maybe this will change with Bristow's exit. Even Agnico Eagle recently, they announced the spin out of all non-core equity stakes into a subsidiary called Avenir. But as part of that announcement, Agnico, clarified that their core focus is on gold and yes, copper. Those are the two metals that they're zeroing in on. And then of course you have at least a dozen Chinese parties that have been very aggressive on the M&A front. You have sovereign wealth funds. The list goes on. So I think it's a great opportunity to sell to larger parties. And then there's of course the supply disruptions. And just in the past 90 days, El Teniente, Constancia, Red Chris, QB, Manto Verde, and then of course, Grasberg being the big one. And I think even though there has been a price reaction to these, shutdowns that have occurred one after another, seemingly on a weekly or biweekly basis, I don't think the market's factoring in the significance of these closures. And we just had data come out from Morgan Stanley. I think it was early this week, maybe late last week. They're projecting the largest copper supply deficit in 22 years next year. So at least some folks out there are recognizing the significance of these supply cuts. So, for these reasons, clearly I like copper quite a bit. But as you alluded to in your answer, I will say that each of our 8 copper-focused holdings, present upside on their own merits. From company-specific developments, this could be drilling, this could be permitting outcomes, this could be pending M&A, really at the independence of the copper price. But of course, a rising copper price would provide a welcome tailwind for each of these investments. I definitely can't deny that.
So, Matt, care to share maybe your top copper exposure? Or if you don't want to share stocks, I get that. Could you address the fact of a jurisdiction? Do you like the U.S. because of some of the fast permitting action? And what sort of a resource? What size of a resource? Do you have a barometer of what a company broadly needs, you think, to get market attention or even that takeover attention?
Yeah, well, for copper, I mean, the kind of the line in the sand for the big boys is, 100,000 tons per annum. We have one company that's, right on that threshold. And it is one that I've written about publicly in the past couple MJG investor letters. So I'm comfortable speaking about that. And that's Corex Copper. That's Hayadon, Alan Friedman and, the whole or much of the Asino team, which had a very successful exit just last year. And yeah, they're pushing forward the Habe project in southern Namibia. I should be on site there in early February, which I'm very much looking forward to. But in terms of our copper holdings, that's the one that has the most leverage to the copper price. It is a relatively low grade deposit that, of course, can cut both ways. But if you catch the cycle right, start plugging in $5.50, $6 copper, and the numbers there look pretty goofy. So that's probably the most directly levered play that we have to the price of copper. Lara Exploration's another name that I've written about for many investor letters in a row now. That's a holding of ours that goes back to 2019. I still classify them as a prospect generator, but you could very well argue that they're a development stage company at this point. They're focused on their 100% owned Plan Alto project. They just put out a PEA there. Not the same scale as a Corex, I'll be the first to admit that, but a very tidy project in a jurisdiction where it is easy to mine. This is in the Carajás district. I was there a couple years ago. I visited Plan Alto itself. I also visited Bravo's Luanga project while in the region. And this is mining central within Brazil. There's recent M&A activity right near Plan Alto. That includes the Turkish group Corex having bought in BHP's non-core copper assets. That deal should close early next year. So a lot of activity and a very good place to mine. So that's another company that I think has M&A potential. And then, yeah, I will say the rest of our copper names, beyond Corex and Lara, I would classify as either exploration stage or prospect generation. So, you could argue those, well, one should argue those are less levered to the actual copper price. But of course, a rising copper price will be a tailwind for those equity prices. That's just the way it works. Lowers their cost of capital for future financings as well.
Well, Matt, you mentioned a couple prospect generators in this call so far, not just lower expiration, but you also brought up Headwater Gold. I would submit there's a third one that I know that you follow, and we actually just talked to the company when we were in New Orleans for the conference last week, and that's Ridgeline Minerals. Saw Chad there at the CEO of Ridgeline Minerals, and they had a drill result that came out on November the 4th. And this ties into the thing we've been talking about here of beyond the precious metals. There's still some pretty exciting opportunities in the base metals. So they're going for a CRD system here, so it's got everything from zinc and silver to copper and lead. It's even got antimony in there and gold, so a blend of different metals, polymetallic. The market sold it off pretty hard though, and I remember Chad just being puzzled that day, thinking, "Hey, like this is a pretty exciting drill hit for us." And they're using a prospect generator model on some of their properties, and then also using 100%, so kind of a hybrid model.
Yep.
Any thoughts there on Ridgeline Minerals?
I have a lot of thoughts. You open Pandora's box there. I mean, we are Ridgeline shareholders. I believe going back to 2021. We've supported the company in multiple financings over the period since. First, it's obviously painful seeing the share price of a significant holding, and Ridgeline is a significant holding of ours. Seeing a share price decline 28% on the back of a single news release. That's no fun at all. But it's also what, those of us who invest in early stage mineral exploration have signed up for. It's the ropes. But, I think it is worth noting that the Ridgeline share price, more than doubled between, we'll say, mid to late August, right up until those drill results were announced. And even after, the precipitous decline that we saw last week, the share price still sits at a level that is higher than it was even going back to the the end of September. So, the sky is not falling, by any means from a Ridgeline shareholder perspective. In terms of the results, and look, I understand this may sound foolish to some, given the market reaction, to those drill results at Salina, but I actually found them quite encouraging. I did. The first point is that this is genuinely a new discovery. Like Chad, Mike, and the rest of the Ridgeline team, like they've been searching for CRD massive sulfides at depth at Salina for years now. Hadn't found it, and they now have officially as of this drill program. And whether or not this massive sulfide mineralization that's been intercepted, proves to be economic at these depths, like that's another question. But for starters, we now know that it is definitively there. I'd say the second point, like this drilling wholly validates the geological model that was generated by Ridgeline in South 32 earlier this year. Like remember this target that they're drilling, it's brand new and it's never before been tested, at least before this drill program. And the model that the joint technical teams came up with has now been validated with these results. This of course is not a small target either. Like we're talking, roughly 2 kilometers laterally from side to side. So it is hard to say that it's been properly tested with assays in hand, from only a hole and a half. And I'd say the third point, and perhaps most importantly from my perspective, like South 32, the earn-in partner, appears enthused by these results. Like some of your listeners that are following Ridgeline closely, may have seen South 32 Chief Development Officer post on LinkedIn, on the day, I think the day after the Ridgeline news release. And first he compared Selena to Hermosa Taylor, which is the world's largest CRD deposit currently under development by South 32. So that's no small comparison by any means. But then more importantly, he said, quote, "We're excited to advance this project in the months and years ahead." And, as you noted, I'm a big believer in the prospect generator model. And really all one can ask for with this model is for continued partner expenditures at a given asset. And these comments, to me at least, suggest that South 32 is eager to hit this target hard next year, really irrespective of the assays that remain from this program. We've got another, hole and a half, hole and a third to go. So big picture, like we did not get the proverbial, quote unquote, this will be a mine discovery intercept. I'll be the first to concede that. And clearly some in the market were hoping for that, given, judging by the share price reaction. But I do think there was a lot to be encouraged by. And really my litmus test for whether this program, should ultimately be deemed a success will be whether South 32 commits, to at least a similarly sized and hopefully larger drill program in 2026, which could in theory start, in April, maybe late April, as soon as the snow melts. And then, of course, in the meantime, there are still assays pending from the remainder of hole 53 and also hole 54, which will be going through kind of the heart of the target. So, it's worth staying tuned for that as well.
All right, Matt, we will wrap it up here. As always, so interesting hearing what you're doing with your portfolio and some of the moves that you have made to build up cash. I think everyone should take note of, look, you're a fund manager. You hear from all these companies. You need to manage this portfolio actively, and you are doing that. So, again, thank you so much for sharing your thoughts with us on our weekend show. Again, Matt Geiger is the managing partner at MJG Capital. Click the link in the show notes to visit the MJG Capital website, read over some of the missives that Matt puts out to everyone that follows along. Everyone, stick around. We are going to be right back, continuing to talk markets and metals.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
The dynamics of the natural resource trade changes every day. Get the full view of the commodity markets every week with Commodity Compass, hosted by me, Jennifer Pickrell. From metals to energy to agriculture, we break down the key moves, market drivers, and macro forces shaping the resource world, all in one sharp, insightful podcast from the Clear Commodity Network. Whether you're a trader, investor, or industry pro, Commodity Compass helps you stay grounded and informed. Listen on Apple Podcasts, Spotify, or at clearcommodity.net.
Hey everyone, Justin Hune of Uranium Insider here, inviting you to check out the Going Nuclear podcast, co-hosted by yours truly and Trevor Hall and produced by the Clear Commodity Network. Each episode, we dive deep into the uranium sector and the fast-evolving world of nuclear energy and uranium investment. From supply dynamics to policy developments and market trends, we bring you the insights that matter most to energy investors and industry watchers. You can find Going Nuclear on Apple Podcasts, Spotify, and at clearcommodity.net.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. We are now chatting with Brien Lundin, editor of the Gold Newsletter, and also our host down at that New Orleans investment conference that happened not that long ago. Shad and I were just down there. It was November 2nd to 5th. You can still get access to the recordings of the speeches and all the talks from the conference. Click the link in the show notes. that'll take you to the site where you can register for all of those recordings. And Brien, Chad, and I have been talking a fair bit to the people that were at the conference and a lot of the companies that were there. And I've been going to this conference for over a decade, and it was, I think, probably the busiest that I have seen in terms of attendees and also exhibitors. The exhibit hall was quite full. I think it just goes to show kind of the bull market that we are in for, especially metals stocks. But there are a number of different companies that also exhibit there, including some energy stocks and some financial stocks. Just a quick little overview then, Brien, of the conference. What did you see in terms of attendance and in terms of exhibitors?
Yeah, the attendance was spectacular. There weren't only a lot of people, there were a lot of happy people, as you can imagine, after the moves that we've had. And the big determinant or the big indicator that I tell people is not just how many people come to our event, but because they're all really highly qualified, really smart people. They pay a lot of money to come to our event, to travel to New Orleans, stay in a hotel for 4 or 5 days, et cetera. So really successful, smart investors. And the indicator isn't whether they've showed up, but what they do when they get there. And it seemed like they were fairly aggressively buying, or at least very interested in all of the companies in our exhibit hall. And I think that's a great sign for the market. We have a lot of fears, a lot of worries that we're ahead of ourselves. And, a lot of the people who have been investing in this sector for many years have been trimming their positions. And while that's never a bad idea to take profits like we've had, what I was telling our attendees is that the extraordinary gains that we've seen are not so much a function or an indication of how overbought or ahead of itself the market has gotten, but rather an indication of how undervalued the sector was for so long. When you have so many companies that are selling for less than $10 an ounce in the ground for years, and now they're selling for $20 or $30 an ounce in the ground. That's, a 2 or 3x move, but it really doesn't mean that they're overvalued by any measure. And those kinds of comparisons run across the spectrum from exploration stocks all the way to the big producers. It's just not a sector that is ahead of itself or overvalued by any standard metric. And now, $4,000 gold, producers having $2,500 an ounce of margin in profit in every ounce they produce. Nothing is valued appropriately to a situation like that.
Well, Brien, I'm so glad that you just mentioned that, because that's something we've been talking about on the show quite a bit, really for months now, that even though a lot of these stocks have moved up 3x, 4x, 5x, they're impressive moves, but they're coming off really low levels. But when you look at the valuations of where not just the gold stocks, but where the silver stocks are, even some of the copper stocks related to the metals, and where their ounces in the ground are being valued, it's still paltry compared to where it's been in other sectors. I think a big benefit of your conference is just talking and networking with all the other investors there, whether they're companies that are there and management teams that are also investors, or just investors in attendance. And I was asking everybody, where do you think we are? Where do you think the valuations are? And a lot of people were doing that cautiously optimistic thing, where they were optimistic but worried that things were pulling back. Did you get any different feedback when you talked to investors? Did you find that there was new people there hitting the bid, or were there seasoned investors exiting overall? What kind of a vibe did you get from the investors there?
Yeah, I think they were seasoned or smart. We did have a number of newbies to the sector who were saying, it looks like everybody made a lot of money over the last year. I'm new to the sector. Is it too late for me? How do I get involved? Kind of a thing. But that was a minority. That was maybe 15, 20% of the attendees. There were, as you would expect, a lot of very sophisticated, experienced investors in the sector, but I didn't see anybody just blatantly hitting the bid. I think they're turning the soil, in their portfolio, as it were. They're exchanging some stories for other stories, some that have gone up to 2 and 3x's, finding some that really have been left behind. There are a few of those left out there that have yet to really move. less and less, it seems, every day, but there are a few out there. So we don't have people really just blatantly selling out right now and, taking their chips off the table for the very reasons I just talked about. I think it was a pretty popular opinion that there's so much money being made in the sector. We're just really in the early innings.
Brien, what do you think about that whole concept of shuffling or horse trading some of the winners for some of the laggards? Because look, there are many stocks actually that are 5x, 6, 7x from where they were, let's say, beginning of this year. But then there's also probably even more stocks that are only 2 or 3x from where they started, and then very few that haven't even moved yet. Do you subscribe to that strategy of trimming some of the outperformers and buying into some of the ones that, while they're still up, aren't up as much as, I guess, some of the better stocks?
Yeah, it's an interesting evolution we're witnessing in the sector right now, which, the easy money has definitely been made, but the tide is still rising and lifting all the boats as well. But going forward, I think the challenge for us is not just being positioned, it's trying to find what the biggest winners are going to be, because most of these stocks are going to be winners. And so it creates a different situation than we've had over the last decade or so, really even longer than that. It harkens back to the issues we had in the 2000s. You're looking for the companies that are going to outpace the rest, but still your losers, as it were. Instead of losing, 50% or more, your losers are actually gaining a little bit because everything's rising. So the challenge is trying to find those faster horses in the race and selling some of your other ones. Now, when you have an exploration story that's made a really big move, maybe you're 5 or 6x, it is a good idea to trim back on an exploration story after you've made those kinds of moves. You can look back on some of these big winners, and Great Bear in our portfolio went up 85 times from the entry point. And you can go back and wish that you would have held every share all the way to the end of that story. But you can recognize too that would have been a pretty stupid thing to do. It would have been maximized your profits, but it would not have been the prudent thing to do, not to take profits along the way. In discovery plays, you absolutely do need to take those profits along the way.
Well, Brien, I think another fascinating part of your conference is the newsletter writer tours that these different folks go on, where they grab a bunch of their subscribers and go to the exhibit hall and talk to the companies and interview the companies and then kind of huddle up afterwards. I was listening to a couple of them from Gerardo Del Real or Lobo Tigre and kind of eavesdropping on them. Maybe highlight that part of your conference and any takeaways that investors had by, not just trying to go it alone, but having a seasoned veteran there to guide them through the conference.
Yeah, that's something we started, I don't know, 15, 20 years ago, and it's such a highlight. All of our exhibitors, you guarantee all of our exhibitors some attention from the investors, and attention that's directed by an experienced hand in the sector who knows what questions to ask. And some of our tour guides, as it were, take it a step further. They then take their group after they've toured a number of companies and either bring them by other booths, or they take them out in the hall and start answering their questions about what they just talked about, the various companies, a real kind of how-to session on how to invest in these stocks. So it's a tremendous value, especially for those newbies to the sector, people who are trying to get up to speed as quickly as possible on how to invest in the sector. And we also had a bit of a pre-conference boot camp on what to look for and what questions to ask companies. So for anyone who's interested, anywhere along the spectrum, from a novice to expert, there you can really gain a lot from those tours.
Brien, just curious, because you do work with a lot of newsletter writers at that conference. We bring a lot of newsletter writers on this show, but in all fairness, we don't bring everybody on. I do have a criteria of the newsletter writers that I think are higher quality and the ones that I want to give some of the show exposure to. How do you go about selecting the newsletter writers that you have at the show? And any tips for some of the new investors in the space when they see all these different newsletter writers promoting all kinds of different, mostly junior companies, but some mid-tiers as well? How do you know the newsletter writers that should be listened to rather than the ones that are simply just trying to promote the flavor of the month for whatever reason they might have?
Yeah, I think it's somewhat experience. I've met just about everybody and actually know everybody pretty well. I think you have to look kind of at the business models. If it's sponsored coverage, if it's paid coverage, well, obviously you're going to take that with more than a few grains of salt and wonder if it's independent. In the old days, there used to be, generally speaking, if you had a newsletter, you did not front run your own recommendations. Then it kind of evolved over the years to where everybody just about says, not, I'm going to recommend a stock and I'm going to buy this stock after you've had a chance to buy it. They say, this is what I'm buying. So they actually buy the stock and then recommend it. I think I'm the last person that's old school enough that I don't front run my own recommendations in Gold Newsletter. But increasingly, there are fewer and fewer real newsletter writers out there that are objectively covering the market. So it's, the number of available newsletters is winnowing down, in my view, because so many of them are just out there taking money to promote stocks. I don't know if you found that as well, but, on our website at goldnewsletter.com, we have a free report, Investor's Guide to Gold and Silver, where I list all of the newsletters out there that I think are the best and the ones that investors should subscribe to, as well as all the conferences that they should go to meet management teams. So yeah, it's tough to be a newsletter writer as a business model because subscription revenue, especially if you have much of a staff to support, really doesn't pay the bills. So that's why we've seen a number of them go toward the sponsored coverage model. And, I just don't think that gets you really unbiased. Obviously, it doesn't get you unbiased opinions.
Well, Brien, in addition to the newsletters and all the booths that people can walk and all the other investors they can network with, you have some amazing content on the stage. Now, I'll admit that I was tied up in many parts of the conference and didn't catch all of it. But when I did go into the conference hall, I caught some of the different panels. I watched a couple that Rick Rule officiated. You were on a lot of them or monitoring some of them. Any of the key takeaways that you want to share with investors here with our audience that you think were germane to investing in the resource space?
Yeah, it was amazing. And now you've got me stumped because so many speakers, or really all of them, really came with great content, wonderful insights. And I really take that as a point of pride because I read everyone, I watch everyone, and I think I have a good idea of who brings value. And there's no other event out there, quite frankly, that brings the kind of value we have in terms of content. We have some 45 speakers, of which you won't find more than one or two at any other event. So great value. If you look down the roster and the list of presentations, there were just so many of them. Our mining share panel had some great tips on it, great picks. Last year's top pick was on the panel, top performing pick was 1911 gold, which went up 700%. So I think if anyone buys our recordings, and that panel alone will pay for that many times over. This is really the elite of the elite, picked by the elite of the mining stock analysts. So a lot of tremendous presentations out there. A lot of them pointed toward how crazy these markets are. Bob Proctor in particular has incredible charts pointing toward how overvalued the stock market is and undervalued relative to that the gold market is. So it's interesting. He's not always bullish on gold. And while he predicts a liquidity event ahead for the stock market that will knock the wind out of gold temporarily, he thinks gold is going up over $20,000, which is, remarkable.
So, Brien, outside of all the obviously bullish precious metals comments and everyone celebrating how well their mostly precious metals stocks have done, anything stand out to you in terms of other commentary for either other metals or a certain classification of stocks, even if they are precious metals, that seem to be getting a little bit more attention, but seem to be the ones that haven't moved yet? Maybe the best opportunities that you heard?
Yeah, a number of people pointed toward energy as being the undervalued sector relative to precious metals. And Rick Rule in particular has been talking about that. And one of the points that I've made is, these relative valuations, they are great and they show you which sectors are overbought and which ones are oversold, but they're not a good timing mechanism for trading. And that, of course, we've seen energy get more undervalued since then. But if you have tremendous profits rolling into an undervalued sector and then buying more as if the investments go on sale, is the kind of strategy where you can really maximize your gains eventually when the sector turns. So that was kind of a theme. We do have companies. We had companies in critical metals and rare earths and copper as well, which I think are all sectors that for their own reasons, not necessarily the monetary factors that we see driving gold and silver, for their own reasons, and really across the board from base and critical metals, battery metals, and the like. It's an extraordinary time because there are so many opportunities out there with fundamentally bullish stories.
Brien, did you find yourself buying any new stocks while you're at your own conference?
I didn't have time. It's crazy. There are companies that I really want to buy, that are buying more of in some cases, that, number one, I have to sell something at this point. I'm so up to my ears in mining stock paper. I have to sell something to buy something, but there are some remarkable values out there. Cassiar Gold is something I shake my head out at. They have over 2 million ounces of gold, huge property position, remarkably undervalued compared to their peer group. I think that's one that the market's overlooked. I think Sun Summit had a wonderful drill hole late summer, and stock popped, and then the market forgot about it. And now they have the money to go back and follow up, which they're doing. That's another one I really like. And I think that Ridgeline had good news during the conference. It had a discovery hole, very, very high zinc. And they had the bad luck to release the news on that big downdraft day when gold lost about $50 or so. They thought they were going to gain 25% on the day with that discovery hole release, and they lost 25%. So, that's one I think that's probably a good value right now as well.
Hey, Ridgeline was brought up in our first couple segments with Matt Geiger as well. But Brien, just I guess one more quick comment regarding some of these drill plays, Ridgeline being a good example. But there's been a number of good examples out there where these exploration stocks have run up quite a bit, 2, 3, 4x ahead of results, usually on the back of financings as well. As these results come out, they really need to be, it seems like, amazing. If we're talking gold, they need 200 to 300 gram meter holes outside of just what we typically would say 100 gram meter hole moves the market. But that's also, again, because these stocks have run up so much. So portfolio management wise, kind of tying back into what you were saying about some of these exploration stocks, should we be taking profits before results because of how elevated the market has gotten for some of them and just what the market seems to expect as a good result these days?
Well, I don't think you can make a blanket statement. Every story, especially in exploration, is different. But you make a great point that the quality of the drill results that we're seeing have been, I think, remarkable over this past exploration season, going from the summer and going into the late summer. I think that's partly due to the fact that companies have been cash strapped for so long. They've been doing the inexpensive stuff, but scientifically, technically valid work of, mapping and maybe geophysical, soil sampling, rock sampling, trenching, everything but the expensive drilling that the market loves, and the market ignores all this other stuff. So they've been having these prospects that really need to be drilled. And finally, the dam is broken, they've got money, and the drills are turning, and they're turning up even better results because they've been able to really do all the necessary preparatory work. I was talking to Bob Bishop, who came this year, and he made the comment to me that he was amazed at the quality of companies in the exhibit hall and their quality of results, that he think it's really taken huge steps forward from years past. And he has decades of experience in the sector. He thinks it's as good right now as it has ever been from an actual value, good results standpoint out there. So do you sell these companies that are developing really good plays? I think it goes back to, you try to find the faster horses, the exploration plays that are getting more attention, because there's a whole lot of companies out there that have great projects that aren't getting that attention. So maybe the catalyst for a lot of these companies is what is going to get the markets to finally look at them.
All right, Brien, we got to wrap it up here. As always, great having you on the show, and thanks again for hosting us down in New Orleans. Next year's conference in 2026 is happening right before and the final day being on Halloween. So everyone that can make it, hope to see you down there next year. In the meantime, all of you, thanks for tuning in to this weekend show. To listen to all our daily editorials and company updates from this prior week, all you have to do is visit our website, kereport.com, or on your podcast player, or on YouTube, just search The KE Report. That's where you can find all of our recordings. As always, everyone, keep in touch with Shad and I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.